Hello everyone and welcome to the latest episode of Market Bites, my favourite, I would say, 30 minutes of my working week to discuss a few different topics, and there's always something new to talk about in the world of finance. So we've got two of the dream team to discuss it with me, Neja, Mulk. How you doing?
I'm doing well, thank you, Sam. It's a new earnings season is starting, so it's busy season actually. So yeah, I'm very good. How are you guys?
Yeah, all good. I mean, earnings season keeps everyone on their toes, doesn't it? Especially for us in part of Europe where the earnings, if they're after close, are 9 p.m. here or later in other parts of Europe. And for Brett, obviously it's the sort of the end of the working day. We obviously got people in Singapore and Australia, so we can sort of cover everything really as a team, which is great. But it is a busy period, and we always have the debate as we go through earnings season whether it would be better if it was semi-annually, or some people would prefer it to stay quarterly. But that is probably for another day to discuss all of that. But Brett, how you doing?
Doing good, like you guys said. Getting into that busy stretch of time. We're not quite. I like how the beginning of earnings season is just like a few banks, maybe an airline, Pepsi, something like that. It's a little more calm, and then 2 weeks from now it'll be just mayhem.
Yeah, it will. It will. I mean, I'm sure there's many people that use the eToro calendar on the app on the desktop, and there's plenty of people that will, use Finviz or Earnings Whispers on X, and it's quite good. Twitter account a few days ago, they posted the earnings for the upcoming. I think it was about 4 or 5 weeks. I think they did, and like you said, really in a couple of weeks, it's big. I mean, even to be fair, I think it's next Tuesday. You got Netflix. They're a stock that we touched upon last week. Along with the Mag 7. They're under a bit of pressure. So that will be a really fascinating report, and we'll come on to talk about bank stocks in a moment. Of course, they sort of unofficially kick it all off, don't they? But along with that, we'll also discuss CPI, Brett. I mean, that came out yesterday. Yesterday afternoon for us in the UK, your morning. It's always funny. I guess we get so many people that listen to this from literally all parts of the world. So when I say morning, some people are like, no, that's evening. So it's you've always, for those listening, you've got to work it around a few different bits and pieces. But we'll discuss that. And then I wanted to focus on Meta, which is one of the Mag 7 stocks that are under a bit of pressure actually at the moment. And I want to discuss whether there's a bit of value there or not. Actually, maybe some people out there think there's a bit more downside to come. But Neja, let's kick it all off then. Mentioned sort of the banks kicking earnings season off, and JP Morgan, Bank of America, Wells Fargo, they've already reported. What do you think people need to focus on from that, and how are you feeling ahead of the rest of the week really?
I mean, yeah, the banks are the first companies that are reporting each earnings season, and they give us kind of narrative. What can we maybe expect from others? Of course, it's not as exciting as probably Netflix next Tuesday or Magnificent Seven later in the month. But anyway, JP Morgan, Bank of America, Wells Fargo, they already reported, and overall they delivered higher year-over-year profits, supported by resilient lending. There is improved capital markets activities. So yeah, that sounds good. And on surface, that kind of confirms that 2025 was one of the strongest years for the sector in a long time. But this is not what this earnings season is about, I would say, because the market already knows that last year was good. The real question is whether this level of profitability is going to continue in 2026 or not. And I think that is where management tone matters. At the JP Morgan, Jamie Dimon continues to emphasize the risks that market might be also underpricing, and that is from geopolitics to inflation, government debt, and across the sector, I think that the banks are kind of resonating this tone. They are trying to warn investors about the risks that is not talked about enough maybe. But for investors, in my opinion, three things matter the most. And first is interest margins, because we can expect lower rates this year. So lower rates support deal making and trading activity. But on the other side, they also compress margins on traditional lending. That is just the basics. So yeah, deposit costs are already falling. So the main question is whether banks can still earn enough on loans or as interest rates are coming down. And yeah, that's the basics actually. But the second is guidance, because with expectations elevated, even small changes in outlook for 2026 could matter more than another solid quarter probably, because if they warn that they're expecting lower profits for the rest of the year, that would be a major red flag. And third is credit quality, because delinquencies and charge-offs could be a key signal whether consumer is under pressure, if they start to weaken their resilience. So yeah, I think that those are the most important points that investors should look for. I also looked at how Wells Fargo stock and Bank of America are trading today, and as I see, both stocks are down at the moment, like 4% down. So I think that's it about bank stocks so far. But yeah, we can still expect some of the reports this week.
Yeah, I mean, I think when you look at the banks, JP Morgan, I guess getting a little more focused on that name, because it's I look at JP Morgan as the leader of this financial sector, whether that's purely from its size, it's an enormous banker, but also Jamie Dimon is like such a key figure in that space and in markets in general. People listen to him when he talks, not just about banking, but about markets and geopolitics. And he does maybe come across as a little maybe too conservative sometimes with his warnings and concerns. But nevertheless, I think people put a lot of weight into what he has to say. But, they gave us sort of that heads up. I don't know if I think it was probably December. It was about a month ago, maybe a month and a half ago, where at a conference they were speaking about, JP Morgan was talking about rising expenses for 2026. And that was, I think maybe that took a little bit of the blow out of the report yesterday, because again, the expenses were a focus point for them. Yeah. But the stock is, like you mentioned, Wells Fargo, Bank of America down about 4%. JP Morgan was down about 4% yesterday, and their results too. Even though it looked like that stock, it just hit new highs like a couple days before. It was like ready to go, and then we get this news, kind of brings it back in a little bit. But I think maybe the bigger news with them in general, but it expands throughout the sector, is the credit card news. You're seeing like Capital One, Synchrony, Visa, MasterCard, those names all take a hit, and JP Morgan also taking a hit on the news of, there are these reports of President Trump saying that interest rates should be capped at 10% on these card companies, and sort of like how that's just really affecting the space. I mean, to me, you can't just slap a 10% on these and change the whole dynamics of the industry. But nevertheless, that conversation's now out there. And even if it's maybe not a likely outcome, just the risk of it being there is being taken into consideration by investors and weighing on the space very clearly.
Yeah, I mean, this negative reaction kind of makes sense, because credit cards are a very profitable part of this business. But I think there is also more to the story, because if we look at the average US credit card annual percentage rate is way higher. It's around like 20-25%, and even higher for these subprime borrowers. But yeah, this spread is not just profit for banks. This spread kind of needs to compensate for all of the default risk the banks are taking to give credit cards to those borrowers. It also covers operating costs, rewards program, and also regulatory compliance. And if you suddenly just cap those rates at 10%, a large portion of this credit cards portfolio simply stop making any sense. And you would think that this is maybe a good thing for borrowers, but it's not the case, because it's not what banks would do. They would do completely the opposite things. The banks would pull cards from riskier customers. They would lower credit cards limits and even scale back those rewards that they were giving to borrowers. And that means that the people that the policy is supposed to help often end up with fewer options. And there is also this legal hurdle because nationwide interest rate cap would almost certainly require approval from Congress and also some changes in state laws. So it's not something that you would do overnight. But yeah, I also love the point that our global market analyst Lale mentioned, and that this proposal is kind of tied to crypto legislation, because banks have been lobbying to limit crypto-related rewards and yields, and this has slowed down the process of this crypto market legislation. And this administration appears to be using this 10% credit card cap as leverage, I would say, because they are threatening a policy that would seriously hurt their bank profits, and it puts them under pressure. So yeah, I think that is a major case around this 10% credit card cap.
Yeah, I'm going to ask a question for the audience here, just where you're listening to. So I know one of my good mates, Robbie, listens to us on his drive to and from work. So shout out, Robbie. But I want people to have a little think. 0 is like no shot at all, and 10 is like the most shocking news headline you can imagine. If you all woke up tomorrow and you heard that Donald Trump and his team have launched a new credit card with the max at 10% interest rate, how much would that actually shock people? Maybe he's just saying this, and this is what we're going to do. 10% is the most, and that's it. And it wouldn't be the most surprising thing in the world. But on that, and great points, by the way, about why they have those rates a little bit higher and the rewards and all of these kind of things, and the risks for them. But this won't be, in my opinion, the last thing like this that in theory might look good on paper for consumers that we're going to see this year, but maybe even just this month with the midterms, right? Trump is on some counts looking like his team aren't going to win that overall. And what better to come out with a few new ideas and regulations and plans to try and get people on side. And it's classic politics 101, really, isn't it? And it doesn't have to go through. If it doesn't go through, he tried, right? And maybe that even looks good. So I think with everything, take it with a pinch of salt. Any new headlines that come out, but it wouldn't be the most surprising thing in the world. But yeah, earnings kicking off. The bank ones are out. Still a few to come this week before market closes for most of those. And one thing that is going to affect banks, of course, is rates. And one thing that can affect rates is inflation. And Brett, how was it yesterday, in your opinion?
Yeah, yesterday's numbers were actually pretty solid, mostly in line with expectations. So that was kind of nice in the sense it didn't really rock the boat too much. But, I think inflation's just sort of this weird in-between state where it's not really elevated. It's elevated, but it's not high. Like when I'm thinking high, I'm thinking of a couple years ago. So we're not seeing that again, but we're certainly not, it's not like low inflation, and especially like if you're talking to people at the grocery stores, people going to the restaurants, because you look at food inflation in the CPI report, and that was, I think it hits second highest number in the last year. The only time it was higher is just a peep higher in August. So the food inflation's been pretty sticky, and that's something that is a week-to-week frustration for consumers. They're going to the grocery store every week. They're seeing their bill. Like, how can my grocery bill be this high? And I think to your point a couple of minutes ago about politicians and trying to like bring solutions to consumers, that's always like a rallying point for whatever really is the opposite party that's in office. Is look at these prices, look at your grocery bill. Like we're gonna attack this, and it's obviously it's never as easy as just bringing down grocery prices. But that's been a key sticking point in the CPI report, and obviously the Fed does not put as much emphasis on food inflation, but just the CPI report in general, they gravitate towards the PCE report, which I believe we get next week. But I think in general, though, when we're looking at economic reports, especially right now, because we went through a record long government shutdown. It was about 6 weeks. And that has not only left us with a few holes in these reports that we're getting. They're incomplete reports, but they've also been extremely delayed. The CPI report we got is okay. It's December's report. It's only a couple of weeks old, so all's good there. But I mean, we have some reports that are hitting now or coming up that are like November's report. I mean, these numbers are a couple months old at this point, which is difficult for investors like, the three of us to the people who are listening to this. Markets operate on a forward-looking basis, not backwards looking. So, we're working with data that's doesn't really gel with the way markets price things. But when it circles back to like the Fed, these reports do have a real impact on what they're seeing and what they're thinking. And when we saw yesterday's numbers, I think it was like just under 2.7, it was 2.67. It shows like it's inflation slowly kind of creeping back lower after that summer bump with the tariffs and goods inflation kind of coming back up. But I don't know that inflation's at a point where it's necessarily a major constraint on the Fed. Like if we really see the jobs market cool off, I don't think these numbers are high enough to say we can't cut more aggressively. But they're certainly not giving the green light to just start cutting now.
I mean, we saw what was reaction of U.S. president yesterday in the media. That, of course, he thinks that Federal Reserve is way too late with cuts. And yeah, I mean, 2.6% is not high at all, but it's still a bit away from the goal that Federal Reserve have, which is 2%. And I was just looking at Fed Watch tool for a March meeting, and now it looks like there is 72% chance for them not to cut and 26% for 25 basis points cut. But what do you think? Do you think that with CPI down to 2.6 is inflation really beaten, or do you support the discussions in the media that inflation could scale back up and we can potentially see higher numbers in following months?
Yeah, I mean, I don't think inflation's beaten. That much to me is clear. We still remain elevated. The Fed's 2% target remained very elusive at this point. And that looks like it will persist, I'm assuming, through the rest of this year, but certainly for the foreseeable future of the next several months, several quarters. But there's a lot of moving parts when it comes to the Fed, and most of which is, what's it gonna look like in June, or when we get into the back half of the year, we're gonna have a new Fed chairman. There's obviously a lot of dramatics playing out right now between the Fed and the administration, which is really not a great thing to see. This is sort of unprecedented territory, the way these two are kind of like going head to head with each other. Which you don't love to see. But I think maybe even today's numbers, we got the PPI report this morning, haven't really had a chance to go through it. But the numbers just in general came in hot, and that's going to play into the PCE number, probably comes in a little high, or has the potential to come in high. And that's where the Fed's going to really put their focuses on that PCE report. So I don't know. This could keep the Fed on hold without question. Certainly doesn't give them the green light to just start cutting, unless something else shows up in the data, like in the labor data.
Yeah. For those listening on the podcast and not watching on YouTube, you'll be wondering, I'm sure, when Brett said 2.67, whether he did the 6-7 hands. I don't know, Brett, if you know that trend that's been going on. I can confirm he didn't, which kind of disappointed me a little bit, to be honest. But for those watching on YouTube, I just did it. So listen, it's all fascinating at the moment. I'm going to read out Trump's post on Truth Social yesterday, just after the inflation report. Just out, great, low inflation numbers for the USA. That means Jerome, too late Powell, should cut interest rates meaningfully. If he doesn't, he will continue to be too late. Also out, great growth numbers. Thank you, Mr. Tariff. President DJT. I mean, listen, I love these posts. They really make me laugh. But I saw a debate yesterday or the day before. I think it actually was yesterday, because overall the inflation report wasn't that bad, was it? Markets liked it, spiked higher initially, and the person who tweeted the initial thought out was like, Jerome Powell's done an incredible job. Like, he's brought inflation back down from where it was in the pandemic, and he's done this and growth is this and that. And then people were either agreeing or disagreeing. And the reply, some were like, well, inflation should have never been that high in the first place. It's his fault that it is. And it's, overall, I think the Fed have done okay, to be honest. I think they're always going to have a little bit of stick, but they've got to be more safe than sorry, haven't they?
Yeah.
So in time, they're always going to be a little bit behind because they need to have the full picture to make a decision. And we're going to have a pause at the end of this month. Nezha, you're saying there in March, it looks like that's going to be the case too. Let's take a step back here. Equity markets are all-time highs at the moment. And even, if it was to pull back 4 or 5%, the way dips are getting bought at the moment, you don't imagine it would last too long. Obviously, things can change earnings season and, the update about whether the tariffs are legal, whether they have to get paid back, blah, 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 blah. There's certainly a few risks floating about, but overall, the market at the moment seems to be okay.
Yeah, it seems to be okay, but one of the big companies that hasn't started the year that well is obviously Meta. It's down 5% year to date. I mean, it's not down. It's 5% down, and we've only started the year. But anyway, it's last week. Brett covered Magnificent Seven and Magnificent Seven stocks, and if we focus on Meta now, there are discussions about Meta out there. We saw Meta before, how it dropped a few years back, like it majorly dropped. And there are discussions if it is undervalued at current levels or not. Like, what's your take, Sam? Is there any technical points that you're looking at or anything like that?
Yeah, I mean, it's always a tough question, isn't it, when you get asked and anyone thinks about it, is something undervalued, because there will be different opinions and it depends on what you look at and all of that. So we'll have a little look through bits and pieces. I mean, just going off some of those Mag 7s, by the way, Meta over 20% away from its all-time high, or 21% down. Microsoft 16%, Nvidia 13%, Tesla 11%. These are off yesterday's closes. Apple 10%, Amazon 6%. Google is killing it at the moment, all-time high. But just on Meta, and I always take analyst targets from the street with a bit of pinch of salt, right? But the lowest target out there is $750, and that's effectively from yesterday's close is about 17% away, 17% upside. So if you were to take your decision based off that, purely solely on that, which is not something I would recommend, then we're undervalued. But Nezha, you mentioned there about the previous time, I think it was back in 2022 when they bottomed out, and it's sort of October, November time. But that was a 76% drop, right? And there's been previous times where they've had decent sized drops as well. And I guess one thing that I like to look at when investing in a company is the CEO. And I think for a lot of people out there, that's one of the main reasons they would invest in a company, especially for the long term. Who are they? Have they got a track record? Do they believe in it? Blah, 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 loads of different things. But if we go back to 3 significant drops that they've had, we'll go back to the IPO collapse, actually, which is incredible. It dropped 53%. IPO'd at $38, fell to 18, so 50% move to the downside. The media was calling it a failed launch and people were criticizing it, and Zuckerberg really pivoted the entire company back then to go to mobile, and then built one of the most profitable ad machines on earth, and the stock recovered. And listen, even if you bought the IPO, yes, you'd have had a 53% drop at its worst, but you're up hundreds and hundreds of percent since then. Go to 2018, so what's that, 8 years ago, and you have the Cambridge Analytica meltdown with the privacy scandal and stuff like that, and it dropped 24% in a couple of days. So these moves, even though it's one of the biggest companies in the world, 20%, 50%, it's not unusual, really. Zuckerberg then responded to all that, tightened privacy control, stabilized the platform, and kept driving growth. And obviously the stock recovered, I think, pretty quickly from memory back then. And if you go to what you just talked about there, Nezha, 2022, dropped to, I think, like sort of 75, 80%. From sort of peak to trough there. And, there people were talking about Apple's killing the ads, the metaverse investment is awful. And, that was mocked by everyone. And I'm sure on the podcast, we probably at times thought, what on earth are they doing there? But, it came out and responded that it was going to be the year of efficiency. They cut 21,000 jobs. They rebuilt their ads around AI. They scaled Reels, and in 2024, from that low, it was up 500%. Put over 1 trillion back on the market cap. So they've recovered from all of these things before. I guess the tricky thing is with any stock, it's very hard to try and pick the exact bottom of something. So if we were to do, a made up poll right now from all our listeners that have got a bit of an inclination about Meta and say, do you think it'll be higher in 5 years? I'd imagine most people would say yes. If we were to ask people where it's going to be trading higher or lower in a month, you probably get somewhere around 50-50. It's hard to know. So I think there's reasons to be optimistic about the future. I mean, there's so many people that use a Meta product, whether that be Facebook, whether that be Instagram, whether that be WhatsApp, and haven't really even started to monetize WhatsApp. I know it's not massive, I think, in America, people using WhatsApp, but I think, and actually a lot of my friends that have kids, their kids refuse to use WhatsApp. They say it's for old people. I don't know whether that's true or not, but that's something they haven't even started to monetize yet. So yeah, I think they'll do well, and that they announced recently some sort of deal from an energy point of view, and I think they signed agreements. I think it was last week, 7.7 gigawatts of power from various different nuclear energy companies like TerraPower, like Oklo and Vistra and Constellation Energy and that kind of thing. So they never want to run out of power. They're giving that sort of confirmation that they're here to stay, and they're going to be a leading player in AI and all of this as well. And I you need a lot of power to win that AI race, and they're sort of saying they found a reliable nuclear source for that power without having to build the power plants themselves. So I think it gives a nice clear path for future growth. The bottom line is, when are we going to have that low? Nobody knows. And also, if we fast forward a few months, let's say this earnings season is awful. Let's say the data is bad in the next jobs number or the next inflation, or the midterms don't go well, or there's a black swan event. The whole market could keep going lower, and Meta's not going to be invisible to those moves. So very hard to predict it perfectly, but I feel positive for the future is what I would say.
Yeah, I think that's a very fair point. I mean, there are some strong points to the company. I checked some of the fundamentals, and their advertising machine is basically killing it, and gross margins are so high, one of the highest of Magnificent Seven. Also, they have 3.5 billion daily active users, which is a massive number. But something that I learned during this episode is that I'm old. I only learned about 6-7 a few days ago, and I love using WhatsApp. So apparently I'm in old group now.
Yeah.
But it is what it is. And I also checked some of the forward Ps for Magnificent Seven, and Meta actually has the lowest one. So these points are kind of supporting that it could be like, there are some points to support undervaluation thesis, but of course there is also a spending point to that, all of that, that they're spending a lot. And this was always the case with their earnings reports. One of the major points investors were looking at. And I think that is going to be with this earnings season as well. If they report more spending, I think that would be one of the red flags investors would focus on.
Yeah, I think so. I mean, I think, was it yesterday or the day before, they cut almost everyone from their Reality Labs thing as well. I think that's about 1,500 jobs that were reported to be cut there, which obviously, look, it's never a nice thing. And it was the first time I sort of got introduced to markets and hearing headlines about, we're getting rid of 10% of workforce. You think, oh my good, like, people new to markets will probably think the same as I'm about to say right now. You think, God, that's awful, I'm selling the stock. But most of the time it's the opposite reaction, isn't it? And that the share price goes higher. It's one of those crazy things where it's horrible for the people involved, but from a purely investor headspace, you kind of think, well, actually maybe they're going to be more cost effective going forward. And I don't know, Brett, have you had a little look at the chart on Meta or anything like that? Is that something that piqued your interest or not yet?
Yeah, I think for me it kind of goes back to this interesting concept that we see it in Mag 7 kind of routinely, where where these companies, it's like a rotation within just this space. We always talk about sector rotation and market rotation, but we really actually see it in Mag 7 often. I mean, go back a year ago and Alphabet was, no one wanted to own Google. It was awful. And now it's the second most valuable company in the world. And we just kind of go through these rotations where a couple of names get really expensive, people rotate out of them, sentiment shifts, and then they become cheap. And then we start to see, eventually we see them come back to life. Now, to your point, picking a bottom on these names is not easy, especially if someone like Meta, I think it's 18, 19 half times forward earnings, and maybe you say 15 to 16 is the trough. For some people who have a long time horizon, they'll just say that's close enough for me. I can sit through, if we go down another 15 or 20%, I can handle that, or, and then look for the bigger rise over the years ahead. But, for other people, they'll say, well, I'll wait until we get down to 15 times. And if we don't, we don't. But if we do, that's where I'll step in. And valuation's kind of a tricky thing too, because it's one of those things where it doesn't, sometimes it just doesn't really matter. I mean, when we had that massive pullback a couple of years ago, this thing got down to 10 times. Yeah. That's like dirt cheap for a business of this quality that has these types of margins, this type of cash flow. And, so I don't know. It'll be interesting to see where it kind of finds its footing. And it just really kind of comes down to people's time frame, I think.
Yeah, it does. And I think that is very key for people listening to this. If you're, a short-term trader, you ultimately don't really care where it's going to be trading in 1 year, 2 year, 3 years. As long as the price moves in either direction, you can trade it. And then obviously if you're, a longer-term investor or medium-term investor, things can change. And then also how you approach it. Are you going to dollar cost average into, the asset, or, do you have a certain rule where you're happy to be in a certain amount of drawdown and, you can hold those positions for a longer period of time. I mean, I don't think it gets down to $400. It's currently trading at 620, but from a technical point of view, if it got down to there, I think a lot of people would snap your hand up, and there's a bit of a gap fill there from one of the old earnings reports. So yeah, I'll be keeping a watch on that, and that would also mark up exactly 50% decline. Is Meta really going to drop 50%? Again, you probably would say no, but it has before. Multiple times, and it's recovered. And of course, if something drops 50% and goes back to its all-time high, that's 100% increase. So from a risk-reward perspective, that would be tempting. But I don't know if we get there or not. But let us know in the comments, as always. Always interesting to hear what you all say or think. Let us know what you want to discuss next week as well. I'm sure there'll be a load of new headlines and load of new stories and load of new proposals going on. But I'm going to have the dream team to discuss it all. So thank you all for listening. Nezha and Brett, thank you very much for joining as well.
Thank you.
Yeah,
see you next week.
Always fun.
Take care, guys. See you then.